Welcome to Wealthfinity, a channel dedicated to helping you understand the world of personal finance and wealth management. In today's video, we will be discussing the basics of the debt-yield ratio, an important concept that every investor and borrower should be aware of. The debt-yield ratio is a critical metric used to evaluate the risk associated with a commercial real estate investment or loan. And understanding it can help you make more informed financial decisions. We will walk you through the definition of the debt-yield ratio, how it's calculated, and why it's important to consider when evaluating investment opportunities. So, whether you're a seasoned real estate investor or just starting on your financial journey, this video will provide you with a solid foundation of knowledge on the debt-yield ratio. Debt yield is an essential metric used in real estate investments to evaluate the profitability of a property. It is a measure of a property's ability to generate cash flow to cover the loan payments. Understanding what debt yield is and how to calculate it is crucial for any real estate investor to make informed decisions and maximize their return on investment. What is debt yield? Debt yield is the ratio of the net operating income, NOI, to the loan amount. In other words, it's the annual net operating income of a property divided by the outstanding loan amount. The resulting number represents the lender's potential return if they had to sell the property in the event of default. Debt yield is often used in commercial real estate lending to help lenders evaluate the risk of a loan. Debt yield is expressed as a percentage, and a higher percentage is always better. A high debt yield indicates that the property generates sufficient income to cover its debt service and can provide adequate returns to the lender. On the other hand, a low debt yield suggests that the property's income may not be sufficient to cover its debt service and that the lender may face a higher risk of default. How to calculate debt yield? Calculating debt yield is relatively simple. The formula is as follows. Debt yield equals net operating income, loan amount. Net operating income, NOI, is the income generated by a property after all operating expenses have been deducted. This includes rental income, minus any expenses such as property taxes, insurance, maintenance, and utilities. The loan amount is the total amount of the loan on the property. For example, if a property generates a NOI of $100,000 and has a loan amount of $1 million, the debt yield would be. Debt yield equals $100,000 per $1 million equals 0.1 or 10%. Interpreting debt yield. As mentioned earlier, a high debt yield indicates a lower risk investment, while a low debt yield indicates a higher risk investment. However, there are no hard and fast rules regarding what is considered a good or bad debt yield, and it can vary depending on factors such as location, property type, and market conditions. In general, a debt yield of 10% or higher is considered good, while a debt yield of 7% or lower is considered high risk. However, some investors may be comfortable with lower debt yields if they are confident that the property's potential appreciation will make up for the lower cash flow. It is essential to keep in mind that debt yield should not be the only metric used when evaluating a property's investment potential. It is important to consider other factors, such as the property's location, tenant quality, and market conditions. Additionally, debt yield does not take into account the potential for appreciation or depreciation of the property over time. Why is debt yield important? Debt yield is a critical metric that lenders use to evaluate the risk of a real estate investment. It helps them determine whether the property generates enough income to cover the debt service, including principal and interest payments, and to provide a reasonable return on investment. For real estate investors, debt yield is essential because it helps them assess whether the investment is worth the risk. If the debt yield is high, it indicates a lower risk for the lender, which translates to more favorable loan terms for the borrower. Additionally, a higher debt yield means that the property is generating enough income to cover the debt service and provide a reasonable return on investment for the investor. Moreover, debt yield is an excellent tool to compare different properties and investment opportunities. By calculating the debt yield for each property, you can determine which investment has a higher potential return and lower risk. When to use debt yield? Debt yield is often used by lenders when evaluating a commercial real estate loan. Typically, lenders look for a debt yield of at least 10% to 12% for a loan to be considered safe. Some lenders may require a higher debt yield, depending on the risk level of the investment. Real estate investors can also use debt yield to evaluate the potential risk and return of an investment. They can calculate the debt yield for different properties they are considering and use it as a benchmark to compare different investment opportunities. In addition to evaluating individual investments, debt yield can be used to assess the performance of a real estate portfolio. By calculating the weighted average debt yield for all properties in the portfolio, investors can determine the overall performance of their investments. Debt yield is an essential metric for real estate investors that provides a standardized measure of a property's ability to generate cash flow to cover debt service. By understanding how to calculate debt yield and how to interpret the results, investors can make informed investment decisions and maximize their returns. However, it is important to consider other metrics such as the capitalization rate and debt service coverage ratio to evaluate investment opportunities comprehensively. In conclusion, the debt yield ratio is a crucial financial metric that lenders use to assess the risk associated with a real estate investment. It measures the relationship between the net operating income generated by the property and the outstanding debt. A higher debt yield ratio implies a lower risk for the lender and vice versa. Understanding the basics of debt yield ratio can help real estate investors to evaluate their financial position, negotiate better loan terms, and make informed decisions about their investment opportunities. It can also assist lenders in determining the appropriate level of risk associated with a real estate investment and help them to manage their loan portfolio effectively.